What is going on, traders? Welcome back to the Traveling Trader. Sorry for the crazy lighting if it looks crazy, but I'm outside right now and it's getting kind of dark and I only have this one main source of light. But that's neither here nor there. That's not what you came for. So I ran across this Twitter post that said, if this were a bear market rally. I will get into that, but basically Milton, Berg, CFA was talking about the rally, the current rally in the market, this violent uptrend that we've had since June 17th, really, and calling it basically saying that if this were a bear market rally, meaning a rally that is a fake out or that's going to result in a fake out and that we're still in a bear market, then this would be the greatest bear market rally of all time. Now, I'm going to go over his stats in this video for sure to provide you with some context, but more importantly, we're going to go over a market update because the market right now is at a major inflection point. But this is most likely going to be a huge resistance level unless the Fed comes in on September 21st, which is the date of the next FOMC meeting, and does something like a tepid rate hike of 25 basis points. For those of you that leave me comments saying, oh, you're bullish one video and bearish the next, I'm pretty sure that you guys only read the titles of the videos and you don't actually watch the content in the videos. This is a constantly changing landscape. It's not that I'm bullish one video or bearish the next. It's that I'm following the market news and the market environment day to day. So, of course, as new information comes in, you're going to develop new opinions. And being bearish or bullish in the market is not a perpetual sentiment. It's not something that lasts forever. Like when we were in the midst of forming this fractal here, I said that if earnings and or guidance were good, then we could see a run up to the resistance point similar to what we saw back in January and March. It doesn't mean that I have to be bullish for the end of time. It just means that these are the interim levels that I'm looking at. And if you've been following my videos, you know that I talked about this resistance level and that it could potentially get very volatile from here. It doesn't mean I'm a bull. It doesn't mean I'm a bear. I'm just giving you the facts straight up as I see it. Because at the end of the day, this is a non-BS finance channel. I'm not here to BS you at all. I'm just here to tell it like I see it. I don't fall in love with stocks and then dig my heels into that conviction regardless of what happens. It's not like I'm, trying to pump Neo or pump Palantir. So I have really no incentive to be a perma bull or a perma bear. And you guys come to this channel for non-BS, concise, regular, accurate market updates, and that's what I'm here to give you. And before we get into Milton's data points about bear market rallies, I just want to say that because of this level here, I opened up hedges. I actually used the balance that's in my entire Robinhood account. I used a separate account for this because I don't want to look at the hedge. I just want to open a long dated hedge. I bought the 315 and the 310 puts on the triple Qs. That entire account is now up 17%. And I also sent this analysis out in the Academy talking about different hedges that one can take here. And for those of you that are asking, yes, we closed regular signups to the Academy. We're trying to keep it a tight-knit group and make sure that everybody gets the value that they deserve. However, we do open up spots. So if you click the link in the description and you see spots to book a call with one of the ambassadors, then go ahead and do that. If you don't see spots, then wait until the beginning of the month and there might be some spots open up. All right, so what did Milton Berg say about the bear market rallies? Well, let's go into this data and then I will tell you why I think this time actually might be different. Milton says if this were a bear market rally, then the S&P gain of 17% off the decline of 23.5% would be the greatest bear market rally ever after a bear market decline of 27.7% or less. Same thing for the NASDAQ. If this were a bear market rally, then the NASDAQ gain of 22.5% off the decline of 33% would be the greatest bear market rally in NASDAQ history after an interim bear market decline of 37% or less. So we have actually had more violent bear market rallies, especially for those of you that remember 2008 and 2009, but that bear market was not a decline of 37% or less. It was actually way more than 37%. And we saw 40, 50% bear market rallies before another drop that ended in almost a 60% decline total. He goes on to say, if this were a bear market rally, it would be the first time new 30-day highs exceeded 50% in a bear market. It would be the first time 92% of S&P stocks closed above their 10-week average. So obviously there are some data points there that we have to pay attention to. What Milton is saying is that this is most likely not a bear market rally and that the stock market actually has found a bottom for this bear market on June 17th. Now, it doesn't mean that we won't see choppiness coming up, but it just means that this isn't a bear market rally and that we won't break the lows of June 17th. Now, for those of you that follow this channel, know that how much I track the Fed's actions and how the Fed's actions have a lot to do with how the markets move, especially after 2008. And if you don't believe me, check this out. This is what we call the federal funds effective rate. This is the Fed funds rate minus inflation, minus CPI. Now, historically, to get us out of high inflation and to get us out of recessions, the Fed kept raising rates until rates were above CPI, meaning that we had a positive federal funds rate. So if you go back to 1970, you'll see that we had a negative federal funds effective rate, and that federal funds effective rate went positive again. 1975, when we had some of the worst inflation this country's ever seen, all the way to 1980, you'll see that the effective Fed funds rate had to cross CPI in order for us to get out of that inflationary disaster. In the year 2000, when we had the worst recession that we've seen really since the Great Depression at that point, we also had to get to a positive federal funds rate in order to get us out of that recession. However, look what happened after 2008. And this is when the Fed introduced a new tool that we've never used before. We've historically used the federal funds rate, meaning the interest rates, right? Like when you see the Fed raise or decrease the interest rate, that is historically what the Fed used. In 2008, they experimented with something called quantitative easing, meaning that the Fed actually went ahead and started buying assets in the markets in order to prop up the markets. Now, this artificial propping up of markets allowed them to keep the federal funds rate low. As a matter of fact, since 2008, we've never had a positive federal funds effective rate, except for a brief blip in 2019, right before the COVID crash. Obviously, the COVID crash happened, a black swan event, and now we are back to having a negative federal funds effective rate, actually the most negative Fed funds effective rate that we've seen since 1975. It actually surpassed 1975. So this is the most negative that the US has ever had their federal funds effective rate. The point being that this time it might be different because the Fed has been propping up the markets artificially since 2008, leading to, unsurprisingly, the greatest bull run of all time, from 2009 all the way to 2020. Now, the reason that you have so many economists coming out against the Fed and the Fed's actions since 2008 in particular is because yes, it's all good and well to keep the Fed funds rate at negative if you want to prop up the markets and if you want to make it seem like money is cheap and you want money to flow through the economy. But then when you have black swan events like COVID happen, and now they are forced to take rates to zero and they are forced to add even more assets to the balance sheet before clearing them out from the last round. Well, now you get yourself into trouble because there's nowhere to move, there's nowhere to maneuver, and you now have to start raising into a slowing down economy, which the Fed has never done. So this is why you see me track the Fed's actions like a hawk, and why I say that a lot of what happens in the market is going to be due to what the Fed does. So come September 13th, when CPI looks like it has peaked again, most likely, right? The Fed is likely going to be extremely dovish in their rate hikes. They're going to do like a 0.25 rate hike or maybe a 0.5 rate hike, but they're not going to rip the Band-Aid off and do another 75 or even another one full point rate hike unless September 13th comes in as a major surprise and CPI is just a disaster and it is way above what we had the last month or the month previous. But if CPI looks like it has peaked, the Fed is likely going to be really easy, especially with midterm elections coming up. And this right here, this rally will likely continue, and it will be an artificial rally because the Fed will have kept interest rates, effective interest rates, still at negative, when in reality, in order to fight inflation, they have to take them to positive and really hurt the economy or cause a recession. So could this be a bear market rally? Yes, if the Fed actually comes in and does its job and continues to raise so that the federal effective funds rate is positive again, meaning it's above, the Fed funds rate is above CPI, and the Fed will be raising into a slowing down economy, then yes, this likely will be a bear market rally, and we could see those June 17th lows even broken. However, if the Fed comes in on September 21st and does a very tepid, lukewarm rate hike, or worse yet, no rate hike at all, this market will continue to rally. Yes, it will definitely continue to rally. As a matter of fact, this whole rally here was from when the Fed declared that we are at neutral, giving the market a signal that, hey, we're going to be easy go ahead and use the money that you have to buy risky equities. However, in my case, because we're at a technical level here, we hit the 0.618 fib. This is the top of the fractal, the same one that we created back in February and March, and we are overbought on the RSI. I'm not comfortable holding large amounts of NASDAQ and S&P 500 stocks without a hedge, which is why I bought that portfolio worth of puts just to protect my portfolio. Now, my hedge is not so big that I'm rooting for the hedge to win. I would much rather my stocks continue to go up. However, I did buy those puts, and we also sold calls on stocks like Apple and Google and Tesla, because when you sell calls, essentially you have 100 shares or more of the stock, and you sell calls in order to keep making those shares work for you and keep getting paid if the stock finds some resistance. But that is it for this video. Let me know in the comment section, is this a bear market rally, or have we actually seen the bottom? I would love to hear from you. You know that I respond or try to respond to each and every comment. Yes, even the ones about my hair getting long, which I am growing out on purpose. Follow me on Instagram for more free finance content. And if you want to catch my travels, I try to keep it interesting. Check the link in the description below. See if you can book a session to improve your trading. If we have spots, then I would be more happy to welcome you. If not, then keep checking back. Likely the first of the month is when we open up more spots. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.